It's really exciting to be able to introduce this afternoon's panel on sanctions and the global economy. As you all know, sanctions have risen to the surface of the kind of economic issues of today's contemporary policy debates. The recent book by the historian Nicholas Mulder actually sort of emphasizes that originally sanctions originated as kind of wartime blockades, part of wartime conflict. And then over time, they've increasingly evolved to being seen as an alternative to direct military conflict. And have led to this increasing debate on to what extent sanctions are ultimately successful in changing behavior in a targeted country, and also in terms of the costs or impact of those sanctions on the countries doing the sanctioning. And one of the things Nicholas Mulder stresses in his book is that on the one hand, in an increased globalized world, sanctions become more effective because the costs of being cut off from international commerce are obviously greater. Yet on the other hand, the very threat of those sanctions in a globalized economy can lead to a walk back from globalization as countries increasingly try to substitute from foreign sources of supply. And we've seen some of those recent substitution in recent events over the last few years. So we have an absolutely stellar panel to discuss this set of issues containing sort of frontier research on these questions, including David Baqaee, Ruediger Bachmann, Oleg Itskhoki, this year's Bates-Clark Medal winner, Lorenzo Caliendo, Guido Lorenzoni, and Ivan Werning. And so I'm going to ask them each to speak in turn for around 15 minutes, proceeding by alphabetical order of last name of the research team members. And then after each of them talks for around 15 minutes, and I think Rudy and David will split their talk between them, we'll then have around 15 minutes at the end for Q&A, discussion and debate. So without further ado, I'm handing over to you, Rudy.
Great. So thanks for having us. I'm substituting in for Ben. And his choreography was that I talk a little bit from the machine room of having recently, sort of worked in the political economy of sanctions. And David will do the hard economics. So I'm going to start, and then I hand over to David, and then he will hand back to me. So the starting point for our paper was really just these remarkable claims by German politicians about an energy embargo on Russia by the end of February, beginning of March. For example, the Minister of Economic Affairs, Robert Habeck, was saying, if we did this, there would be mass unemployment, poverty, and social unrest. Chancellor Scholz, millions of jobs lost. And then later, that was in May, the lobbyists came in, for example, someone from the Bavarian Business Association, 6 million jobs in danger. And of course, if you know a little bit about German history, every school child in Germany knows 6 million unemployed, that's right around 1932, 1933. That means if someone uses 6 million unemployment figures, Hitler comes afterwards, basically. So this is, so we wanted to get, we wanted to make sense of these claims. And, we were thinking about a framework to help us think about both the mechanisms that would be involved, presumably something to do with trade, substitution using imports, and the numbers, namely substitution elasticities. Our point was not to make a point prediction in the way you would do it in a regular business cycle forecast, but to kind of get the order of magnitude right. In other words, would this be a Corona type of recession or much worse? That's basically really, at least my view of what we were trying to do. We wanted to open up a discussion, not close it. And we also, in the paper, did not make a policy prescription in terms of let's actually do an embargo, let's have a tariff or price cartel. It was really a what-if paper, although that's kind of got mixed up because admittedly some members of the team, me included, Ben as well, Christian Bayer, also signed various memoranda actually going for an embargo. But that was political activism, not science. But we did make, and this is going to be important later to understand the situation we are right now in Germany, we did make policy recommendations conditional on a gas import stop. How to fight it, basically, or how to make it less worse. Okay, so what we did is we assembled an interdisciplinary team of macroeconomists, energy economists, and policy advising economists, and then David ended up doing all the work.
So I'm responsible for anything that's wrong in the paper. Thanks a lot, Rudy. As Rudy mentioned, our objective here was just to try to get some back-of-the-envelope order of magnitude type sense of how costly this would be for Germany. And so the headline number that we came up with, or the order of magnitude that we came up with, was something in the order of 0.5% to a 3% reduction in aggregate output. And you can think of this as GDP or domestic absorption if you like. There's differences between the two, of course, and I'm happy to talk about those differences later on. So that means that we would expect this to be something slightly less severe than the COVID recession, which was about 4.5 percentage point decline in GDP. And it's certainly not something that you could put on par with the Great Depression, which is really kind of the thing that we were pushing back against. We just thought those Great Depression-like scenarios were unrealistic. Good. So how do we think about this? I mean, this is a lot of math, I think, for a policy panel, but I think this equation is very helpful. It certainly helps me to think about questions like this. So to start with, when we want to think about this question, I think the obvious place to start is just to start with perfect competition and think about, if we have a perfectly competitive economy, what do we expect should happen to real domestic absorption and real GDP if there's a problem importing some good from overseas? So this equation I've got at the top is a change in real consumption. You could think of it as a change in welfare, if you like, in a trade model. And the first line is basically giving you first order effects. And the second line is giving you nonlinearities that are associated with this shock. So what are these terms? So this is the change in the different, so this is an open economy that's trading with the rest of the world. If you think that there's a shock that's going to adjust and change the amount of imports that you're going to bring in, well, obviously that's going to affect the home consumer by some amount that's commensurate to how much the home consumer is spending on the good that you can no longer get. So this is a very standard effect. There's an effect that has to do with the amount of exports that you have to sell to the rest of the world in order to be able to buy this good. So if you suddenly have to start selling a lot more in order to be able to finance your consumptions, then that's going to affect you as well. And then finally, there could be a change in employment. So if there's a change in the employment of different factors, then that's going to affect real consumption by the extent to which these factors are earning income for you as a share of your total income. So these are kind of like straightforward in the sense that we can put numbers on these. We know something about how much the German economy spends on different kinds of goods, and then how much we might expect each of these goods to change. But of course, something that's special about natural gas or energy in general is that we would expect these effects to be very nonlinear. Energy plays a crucial role in supply chains. And so we want to be able to think about that. I think it's a little naive to just say the effect is going to be the expenditure share on energy times the reduction in energy. That's true in a Cobb-Douglas world, but not outside of it. So what the second term is taking into account is these nonlinear effects. Now, in a competitive model, the way these nonlinear effects are going to manifest themselves is through how quickly the expenditure share on energy changes in response to the shock. So I think it's useful just to think in terms of these numbers. Just how much do you imagine the expenditure share on energy could plausibly increase in response to this shock? That's going to help you put some discipline on the aggregate consequences of the shock. And down there, we've got a similar equation for real GDP, which is production as opposed to consumption. So if we wipe away what I'm claiming to be unimportant terms, then the key uncertainties that we have to sort out are how much do we expect energy to fall or natural gas to fall in Germany? How much do we expect the expenditure share on energy to spike in response to this shock? This is going to capture the role of complementarities, essentialness, everything about the input-output that matters will load into this term here. And then finally, how much do we expect employment to change in Germany? And so obviously this last one is something that's really going to depend on how German policymakers decide to react to this episode. This is not something that's got anything to do with physics. This is more a matter of monetary and fiscal policy. Okay, good. So here's an order of magnitudes calculation. We have some energy economists on the team who advised us a reasonable number to go with for the reduction in natural gas imports into Germany from an embargo or from cutting off Russian gas would be something on the order of 30% or 30 log points. And then the initial expenditure share of gas in GNE or GDP is about 1.2%. So what we did is we said, just to get a sense of the magnitudes, we might imagine that in response to this shock, perhaps the expenditure share on energy quadruples in Germany. So this would be comparable to the increase in expenditures on oil during the 70s, during the oil crisis. But this is so simple, you could just do your own exercise and say, no, let's suppose it goes up by a factor of 10 instead of a factor of 4 and see what happens. And so here's just that calculation holding employment constant. This is sort of the physics part as opposed to the unemployment part of the effect on welfare. And you could see that if the effect on the expenditure share is that it quadruples, then you're going to get something on the order, a reduction on the order of about 1 percentage point. If you thought that it went up by a factor of 8 or a factor of 10, you could get this up to like 1.6% or something like that. So that's sort of right in the middle of that range that I mentioned at the beginning of between 0.5 and 3%. Now, on top of this, you might expect there to be some Keynesian effects. So for example, if this policy is inflationary and this inflation is not accommodated by the central bank, then this might result in some unemployment in Germany. And so to kind of like add that in, you can roughly think of doubling this number, because this is an inflationary impulse to Germany. If you try to counteract this inflationary impulse, I mean, maybe the central bank chooses not to do that, but if they do try to counteract it, then it's going to cause employment roughly equivalent to the size of the initial shock. So that's just sort of a back of the envelope thing. Here what we do is we take a series, so this is like the first column is the back of the envelope. What we can also do is we can take specific structural models of the economy, feed in the shock, calibrate elasticities, and see what sort of numbers we end up with. So the first one is a simulation done in this paper that I have with Emmanuel, where we try to build a model with a full input-output structure of the world economy with lots of complementarities in production. And we get numbers that are quite a bit smaller than the back of the envelope that I just did. I can explain why this is in a second. And then we also just try taking a simple CES production function, calibrating an elasticity of substitution, and feeding in the shock. And again, as long as the change in the expenditure share is not bananas, the effect is not going to be crazy in terms of how it affects welfare. So for example, for these numbers, we used an elasticity of 0.04. To get really big effects, you really need to go close to 0, at which point the expenditure share is going to shoot off to infinity in the limit. Now, I'm going to hand this back to Rudy, but before I do that, I just want to mention some limitations of what we have, what's missing from the calculations on this page that I'm showing you. The first one, as I mentioned, is business cycle amplification effects to do with Keynesian unemployment. The other thing that I think you could criticize this big trade model is that it uses the standard assumption that the trading technology is linear. So I think that's probably pretty reasonable for longer run calculations, but in the short run, you probably would think that trading technologies have quite a bit of decreasing returns in them. So that's not something that we built into the big model, and so it's not there. That means that the reason this number is small is because there's a lot of substitution that happens. Once you cut Germany off from Russia, well, you could start importing from other people that you're connected with, and you can scale up those imports linearly because of the way the technology works in the model. As I say, if you were to change that assumption, it would just result in the energy share spiking by more. So you can go from there directly. The other thing I want to say is in our simulations, while it's true that the trading technology is linear, and I think that's a shortcoming, one thing that we did think about and one thing that we did put in is we made employment and capital in each sector immobile. So we don't have that in response to the shock, the whole structure of the German economy shifts towards producing completely different stuff. There is quite a bit of decreasing returns to scale within each sector because capital and labor can't move across sectors. Okay, with that, I'm going to hand back to Guido.
So what came out of it? Failure, mostly. The lobbyists were there before us. This is from the Financial Times of the 21st of April. German boardrooms are in uproar. German government officials say they have been inundated with letters from industry insisting how systematically relevant everyone is. Chemical sector, the beer industry in Germany claimed to be systemically relevant. Which is true, even the salt pretzel industry claimed it was systemically relevant in an article, believe it or not. We got sharp attacks from trade union and employer association economists. Models can't be trusted. The chancellor on national TV said it is irresponsible from economists to use these models. And, you know, sort of being self-critical in hindsight, I do think that at the end of the day, we perhaps focused a little bit too much on being right about the numbers and debated these numbers. And we focused to a lesser extent on, say, intermediate policies. Why defend the gas embargo and rather think harder about a tariff or a European demand cartel? But at some point, the political debate was poisoned, so you wouldn't be even listened to for these ones. And certainly what is in the paper, and this is really important for the discussion now, is there was an utter neglect of the discussion of the policies conditional on a gas shortage, mostly or most probably now not instigated by Germany itself, but Putin as a measure in the economic warfare. Okay, and so there's things like stop using gas for producing electricity and using lignite coal, which Germany has in abundance. We didn't do that. There's still a gas subsidy in place. Can you believe it? For industry. And there are no hard incentives for households to save until now, because they sit on long-term gas contracts, so we have an important nominal rigidity. I would call it a fatal nominal rigidity in the system. Public opinion turned against us, and certainly against the embargo. I will say what the Ministry of Economics did, and his team, they did remarkably well on the supply side. They really did a good job. They worked with Norway, the Netherlands, the UK, the US stepped up. The floating LNG terminals are probably going online in December. That's the plan. And they can substitute a ton of gas, even one of the things. So it's really remarkable. And so roughly, rather than the 55% that we used as the starting point and cut it down to 30%, the dependency of Germany on Russian gas is now 37 already. Okay. My remaining pet peeve: there's still a Pyrenees gap between Spain and France, and because France refuses to let Spanish gas into the EU for reasons I still cannot really comprehend. So if you do the math, the Bruegel Institution in Brussels has done this very recently. Currently, we are at a 30% gas gap in Germany. So demand has to be reduced by 30% to kind of not ration. And this does not, and we still have the easy measures like substituting electricity production that would help us cut down these numbers. The floating LNG terminals are also not in this number. One LNG terminal basically would cut this down by 5 percentage points. I just talked to the guy. So there was some success. We got a scientific debate going, many studies. So that was actually positive, a positive surprise. A lot of think tanks that should have done these calculations instead of with staff of 10, 20 economists doing this, should have done these calculations even before us, stepped up and did. And mostly they find orders of magnitude similar to what we had. And finally, just in a few recent days, there's, and of course this is soft evidence, but it is evidence nonetheless, beginning evidence to see that now with the impending gas shortage, some of the mechanisms we have assumed in our paper are actually beginning to appear. So this is, I just copied this from Oxford analysis. You can see a spike in chemical imports. Sort of intermediate chemical products are now being imported to an increasing degree, and chemical production stays flat. So it seems to be that in the chemical sector, people are starting to enhance their international trading network. And a very concrete example of this is now BASF, the biggest German chemical firm, has a plant in the United States that apparently can completely substitute for its ammonia production, which is important for fertilizer production. And this was a big topic also with the world hunger crisis that's currently going on in Germany. Finally, there's a recent study on how much gas German households have already reduced. These guys found it was 6%. And if you compare this with effective natural gas prices for households that have gone up, but not fully to the market price, that's the aforementioned nominal rigidity, you can compute that there is an elasticity on the household side of roughly minus 0.1. And this is close to the numbers we have used. So we have seen some confirmation there as well. So I would say on the science side, partial successes, I think. And but on the political economy side, more or less utter failure. What's important now is the outlook. I would say the political debate on gas embargo, gas tariff, gas demand cartel is over. What we need to focus now on is serious demand reduction measures. We have unfortunately massive legal hurdles. These are EU hurdles, so to change that, you have to get an EU consensus. There's a lexicographic prioritization of private households over industry. If that stays in place and we run into a gas rationing, then there will be serious damage in industry, indeed. We have to get rid of these nominal rigidities in the gas contracts. And ideally, you do some kind of Econ 101 thing. You really don't have to invent the wheels, I think, where you let the prices work, the market prices work quickly, in this case, probably by government fiat, and you compensate poorer households based on previous demand payment, but so that at the margin, everyone has an incentive to save. My only hope is that we get this done. I'm somewhat positive still, because it's pretty clear that politicians fear political rationing as the devil fears holy water, because you really do not want to be in the business of telling people, you can't shower on those days or something like that. All right.
Thank you very much. Handing over to you, Lorenzo.
No, thanks to you, Steve, and Pablo, for basically putting us in the program. This is basically a work with Fernando Parro, and we actually be trying to think about the global economic effects of trade sanctions. And I'm going to be more specific about what do I mean by trade sanctions in a moment. So, as we have seen, countries have imposed trade sanctions to Russia that restrict basically the possibility of Russia getting access, basically Russia to export certain goods to the world economy. There have been restrictions imposed today, and there's like a commitment that supposedly at the end of the year is going to be even more restrictions imposed on Russia's exports. So what we want to understand is what are the global effects of these trade sanctions. So what we're going to do is we're basically going to build on new developments on the quantitative trade literature. In fact, we're going to basically build on Caliendo and Parro 2015. We're going to think about a world economy with multiple countries, multiple sectors. It's going to be trade in some tradable sectors. Of course, it's going to be non-tradable sectors. Importantly, supply linkages and the role of natural resources. And you're going to see in a moment why, of course, the previous talk was very complementary to what we're going to be doing, why it's so important to include natural resources into this discussion about trade sanctions and in particular to Russia. In terms of the data source, we're going to try to get to access to the most, we believe, comprehensive data source today to think about answering this question. So we're going to be using the GTAP 10 data source that has 121 countries, 65 sectors, 121 input-output linkages, and importantly, it has by sectors, and in particular the sectors that matter, basically the use of natural resources in production. And the focus of this talk, this 5-7 minutes I'm going to be talking, is going to be focusing on sanctions on Russia's oil and gas sector. So let me first talk about the geography of production in the world of gas and oil. Let me tell you who are the big players in the world in terms of production, who basically exports more, who imports more in these two sectors, and then tell you why we need to basically move away from a very standard model like Caliendo and Parro and add the role of natural resources to think about this particular question. And then I'm going to consider two particular policies, if you want, in terms of trade policy, to study the effects of sanctions in Russia and in the world economy. So in terms of the geography of world production, what you see in the map is basically, who are the largest producers of oil in the world? And of course, no surprise, Russia actually is one of the largest producers of oil in the world. And of course, you see the Middle East is very clear, very dark green. And then of course, it follows Russia. And if you look at gas, it's even more, there you are. So that's oil, that's gas. You see that Russia, of course, in gas, is also a very large producer of gas. So when you're thinking about, in this case, this trade sanction, you're basically sanctioning a country that has a very particular characteristic in the world. It's a large supplier of two important inputs in production in the world economy. because they have access to these natural resources. So if you look at, for example, in terms of exports, who are basically the largest exporters, no surprise, I mean, it's these countries that basically are the largest producers that also exports basically these goods to the world economy. And that's exports of gas, and in particular of gas, Russia is a larger player as a large exporter to the world of gas compared to oil. And of course, imports, then you have to look ahead to the rest of the world. Then you see like China and India, large importers in the world economy of oil. And when we look at gas, it's kind of more spread out. Something you cannot see because it's a matter of scale. I mean, Europe, of course, imports oil. And when you look at gas, of course, Europe, I guess you guys were looking at Germany there. But I mean, okay, so Europe, of course, is a big importer of gas into the world economy. So bottom line, it's we're going to consider the effects now of, let's say, US and Europe, okay, European countries, unilaterally imposing what we're going to call restrictions, trade restrictions into Russia. We're going to allow other countries in the world, China, India, etc., to still import from Russia. So we're not going to do zero consideration in terms of like, is the world going to basically coordinate in these sanctions? We're going to assume that US and Europe directly are the ones that are going to impose in the sanctions to see how far we go in terms of the effects on Russia and the world economy of these sanctions. What are sanctions for us? I'm going to consider two scenarios. One scenario is going to be the US and Europe ban imports of oil and gas completely into their own countries. The second scenario we're going to consider is going to be that US and Europe impose a tariff that maximizes global income. And what I mean by global income means income, real income of the world economy without Russia. So it's like, suppose the US has an objective, US and Europe, objective of maximizing global income. And of course, to the extent that we're going to allow, as I said here, we're going to model natural resources as a fixed factor in production in the oil and in the gas sector in Russia, those rents generated from this fixed factor of production are going to be used in the national economy, in this case, in Russia. So we're going to be seeing how the rents of these local factors, of these fixed factor natural resources, are going to be basically changing as the US and Europe impose tariffs into Russia. So these are the two axes that we're going to basically consider and look at the effects. And then I'm going to basically summarize and tell you kind of what we're looking forward to continue doing in this research agenda. Yes. So first, so what you see here is, again, so this is US and Europe, group of countries in Europe, basically restricting completely the imports of oil and gas from Russia. A small point to consider, which I say here, is like importers need to substitute away from gas and oil, exactly what you were saying, David. However, only countries which actually have access to these natural resources can actually supply these goods. So there is substitution going in, but at the end of the day, you can only get access to these inputs, oil and gas, if, I mean, those countries that actually produce it actually continue supplying those goods. But we're going to think about this as a medium run because we're going to fix this factor of production, let it fix. Basically, the natural resources to basically produce oil and gas. So what do we find? So very heterogeneous effects in the world economy. So of course, Russia is the country that basically loses the most. The world economy loses from basically this directly imposing tariffs, basically restricting completely, the imports of goods from oil and gas from Russia, and very heterogeneous effects. You're going to get many countries, of course, those countries that depended on the oil of Russia, basically losing more respect to others, and other countries gain. Norway, etc., are able, for example, to gain as a consequence of what? They are now become important suppliers of oil and gas to the world economy. A second exercise that we did, which I'm not going to show you now, but I'm going to basically relate that exercise. This is the US and Europe not buying goods from the rest of the world. We're not buying goods from Russia, oil and gas. Suppose at the same time, the rest of the world signs a free trade agreement in oil and gas to the point that basically they import this oil and gas at zero cost among each others, right? It doesn't change too much the magnitudes. And that's part of the consequence that still it's very low today, the cost to basically import this oil and gas across these economies to the world economy. The second exercise that I do is I'm going to basically move around and think about, okay, suppose the US and Europe impose a tariff on the imports of oil and gas from Russia. So this is, we're talking about two sectors. We're talking about US and Europe unilaterally imposing a tariff of imports of oil and gas from Russia, moving from something like, so this is 1 plus the ad valorem tariff. So it's like 1%, 2%, that would be 20%, 40%, 60%, and so on. And what I'm plotting here is the global effects. What I mean is the world real income change from imposing this unilateral tariff into Russia, and the effects that it has also on Russia's real income. Of course, part of this is driven by the fact that they have this fixed factor, and now they're getting less rents from this fixed factor. Yes, they can sell it to China and India, but the fact that the world economy is demanding less from them, that's basically reducing those rents, and of course, hurting, in this case, real income in Russia. So bottom line, what we find, there is an optimal tariff, although we're thinking about two sectors, there is an optimal tariff that the world actually can think about. In this case, as US and Europe imposing a tariff to Russia, a tariff that actually maximizes, if you want, welfare in the world economy. I mean, what would happen there if we were to impose that optimal tariff? It would not be a tariff that basically minimizes rents in Russia. It would be a tariff that, of course, maximizes world GDP. And of course, I'm not making any discussion about how you distribute these incomes across the world, right? I'm thinking about how the world income will increase, but very heterogeneous effects. In fact, how do you see these heterogeneous effects? You see it in this next map. This is, if we were to actually impose that optimal tariff that we find numerically, which is roughly close to 13.5% unilaterally, US and Europe imposing Russia on oil and gas, what we find is that very heterogeneous effects. Yes, Russia loses, but it's not the only one country that loses. I mean, other countries in the world also lose. On aggregate, you do find that the world income increases, but of course, to actually obtain these gains, you need to find a redistribution scheme across economies in order to basically achieve those gains. So I guess bottom line, I guess we find that trade sanctions generate aggregate welfare losses. We find that they generate, in trade sanctions, by here what I mean is basically sanctioning, let's say, not buying goods from this country that we want to sanction or imposing a tariff, generates very heterogeneous effects with maybe some unintended consequences. The fact that other countries are going to, in fact, be worse off on the fact that you are sanctioning Russia. We find that there's little space for trade policy to reshape the geography of oil and gas production, and especially to offset these losses. And that's related to the substitution question that we were talking about before, that you guys were talking about before. Bottom line, we found that it's hard to escape from the economic losses of trade sanctions to a large producer. And that's important. I guess in this particular case, we're talking about sanctioning a large producer in the world economy, producing an important input in production, which is oil and gas. Extensions, and where we have seen ways that in the medium run and long run, you can actually find sanctions that can actually hurt. Well, that would actually entail reshaping the structural global production. And that, of course, takes time. One is, if it is the case that we improve productivity in these sectors, right, oil and gas and the rest of the world relative to Russia, of course, you're going to see that Russia actually loses more and the rest of the economy will actually gain more. Another option will be reductions in non-tariff barriers that can facilitate the access to oil and gas across countries in the world. That's another option that could actually generate potential larger gains to the world economy. Not necessarily larger losses to Russia. We find, our preliminary estimates means that reducing basically non-tariff barrier trade costs by less than 1% will generate basically that every single country would actually be better off eventually. And we're working now on effects on growth. Thank you.
Lorenzo, that was terrific and great to get insights from quantitative trade models there. Very much complement, two presentations very much complementing one another. And then our third presenter is Oleg. I think his slides are also here.
Awesome. Thanks so much, Steve and Pablo. So unlike Lorenzo, I'll focus on what's actually happening in the Russian economy. And unlike David and Rudy, I will try to do it with not a single equation. So this is based on my work with Dima, who is here. And so tomorrow he will be presenting a companion paper. Sort of this analysis is based on an optimal exchange rate policy paper that we have with him. And he will show some equations tomorrow in a IFM session. So basically, the starting point for this paper was this puzzling behavior of the Russian exchange rate against the dollar. So before the war, it was kind of very stable at 75 rubles per dollar for the past 8 years, since 2014-15, right? So the central bank kind of supported this value of the exchange rate, probably using open market operations, selling and buying reserves. But then as soon as the war has started on 24th of February, there was this massive devaluation, right?
Could you get closer to the
Oh, yeah. So as soon as the war started, there was this massive devaluation. There was a bank panic. Sort of the value of the ruble collapsed. The rest of Western countries imposed like unprecedented sanctions on the reserves of the central bank and on the Russian central bank. But then suddenly ruble stabilized sometime in late March, and then there was this completely puzzling appreciation of the ruble. So first ruble was going back towards its pre-war level, and then it appreciated beyond that, and sort of like by June it was already stronger than before the war, and it kept appreciating in June to like a level around here, and now it came a little bit back with the decline in the recent decline in oil prices. And so the question is, what was exactly going on with Russian economy, right? And so, in fact, if you do a quick Google search of best performing currency of 2022, you can find a lot of, insightful read on that. Obviously, if you're a foreign investor, you couldn't quite take advantage of that. So investing in, ruble assets was not quite available for, foreign assets. But if you were in Russia and you chose to keep your savings in rubles, indeed you did better than keeping your savings in dollars or euros, right? And so here's another picture. This is what happened with the policy rate. And so it's Russia against Ukraine here. Well, so the policy rate in Ukraine, skyrocketed and keeps going up, while in Russia it went up fast. But then by now, the Russian central bank cut the policy rate. It, kind of coming back to the normal levels. There is a recession in the Russian economy, probably lower than what was anticipated before. But overall, sort of like the banking crisis didn't realize, and sort of the financial market has been stabilized. And so the question is exactly what's going on there. So the last picture that I'm going to show is a trade. So this is imports, and indeed import sanctions were imposed, and you can see this is like monthly imports. They have collapsed by about 50%. And what's interesting here is that it's not just from countries that impose sanctions, but imports from China have decreased as well quite a bit. And so Russia has closed a lot of the data sources. So this is constructed indirectly from trade that the other countries report with Russia and like aggregating. And so it's actually quite hard to find direct data in the Russian economy now. And then if you look on the export side, well, in these blue bars, this unprecedentedly high levels of export revenues, the 100 billion euros that Europe transferred to Russia is somewhere in there during the months of the war. And so the black line is the trade surplus, which also reaches unprecedented levels, and mostly it's because oil prices, this is the chart for oil prices, they started at 70 and they reached 120, and just recently they started coming down back to like 95. This is, and on top of it, indeed there was a discount at which Russia was, from what we know, at which it was selling oil internationally from some of the over-the-counter contracts that, we know about. It looks like there is a pretty sizable discount on sales of Russian oil to third countries. Obviously going forward, probably there would be some type of evasion of import sanctions, and this might mean revert. There would be, some type of sanctions are phasing in from Europe, so export might decline. And then, we don't know what will happen with that discount, right? So there are arguments why the discount can get bigger if Europe stops buying Russian oil and gas, or, the discount can get smaller as Russia finds alternative, places to supply oil. So what we tried to do here is we want to sort of address some of the positive questions. Normative questions are hard. What's optimal to do is really difficult, and you could kind of see it from Rudi's discussion why it's so difficult to sort of conclude what's the right thing to do. But some of the positive questions can be answered, and we can find common grounds using sort of fairly simple models here, right? And so first of all, what exactly happens with the ruble? It depreciates, then it appreciates. Does it make sense? Can we conclude from that sanctions are actually not working? Or we cannot conclude that, or we can actually, in fact, that it's a sign that sanctions are working. There is an argument in the debate that maybe, under financial repression and financial autarky, ruble exchange rate is completely irrelevant. So if you are like a foreign investor, you cannot invest in Russian assets. Anyway, so maybe that exchange rate is altogether irrelevant. That's another question we can address. And sort of like, what are the implications of all of this for government revenues, which in a way is one of the important questions, because, this revenues is used to finance the war, and sort of like the ultimate goal of the sanctions is to limit the, financial fiscal ability to fund the war. Like, can we say something what happens with the revenues, right? And so to do that, we build on our recent work, and kind of like in a nutshell, the answer is sort of like really simple. So you think about exchange rate as being a price that equilibrates the currency market. So you really have to think about demand and supply in the currency market. And if you sort of think about what is the supply of currency to the Russian economy, well, there are two sources. It's either exports and it's net foreign reserves, net foreign assets, and in particular, the official reserves of the central bank. And sort of the sanctions could have targeted exports. They did not. Not yet, and then there was indeed an asset freeze on the central bank. So this type of sanction was in place, right? Then, if you think about what is the demand for currency, there is again two sources of demand for currency. One is you need currency to buy imports, and the sanctions really targeted imports. So, like the heaviest part of sanctions was centered on imports. So it's reduced this massive source of demand for currency, which you need currency to buy imports, and now you cannot. So this reduces the demand for currency. And then the alternative use of currencies as a vehicle for savings, right? Sometimes you might want to use foreign currency as a safe asset in cases when other safe assets are unavailable. And the bank run, the collapse of the stock market that happened in March, they all kind of pushed people to want to save in foreign currency, use foreign currency not to buy imports, but use it as a vehicle for savings. And so the response to that was now financial repression inside the Russian economy by the central bank. So kind of both things happened, like the demand for currency increased as a safe asset, but also there was a financial repression by the central bank to undo it, right? And so then what does the exchange rate do? Well, it has to equilibrate demand and supply. So if currency is scarce in the market, then ruble depreciates. If currency is abundant, ruble appreciates, right? And essentially the whole story here is about the balance of these two forces, and you can kind of see how initially it was the asset freeze that led ruble to depreciate. It was the shift of people into saving in foreign currency when the stock market collapsed and there was like almost a bank run in the Russian economy. But then the government cranked up financial repression, and then exports exceeded a lot imports. And so this was kind of the sequence of events that was happening that largely explains what's happening with the dollar. And like the most recent developments is ruble is so strong that the government essentially rolled back most of the financial repression in the economy to sort of avoid further appreciation of the ruble. I'm going to largely, so Guido and Ivan have a paper that focuses specifically on the goods market. I'm going to kind of say just two words. So this was about the currency market, and sort of thinking about the nominal exchange rate as the price that equilibrates the currency market. Obviously, you have to think about the real exchange rate at the same time, which is sort of like a price that equilibrates the goods market in some ways. And so, what's the link between the two? Between the two, the link is monetary policy. If monetary policy stabilizes inflation, it actually creates a link between nominal and real exchange rate, right? And so far, there has not been monetary inflation in the Russian economy, right? So the central bank did not monetize the debt of the Ministry of Finance, or didn't help the budget yet. So there was really, inflation really reflected the scarcity of the import goods, but not the monetary inflation. So as a result, this link is there. And if you kind of understand what happened to nominal exchange rate, you have to figure out the forces on the goods market side of what's happening with the real exchange rate. And sort of like, I'm going to go very quickly. Well, the answer here is Lerner symmetry. So basically, this is the classic result, perhaps underappreciated, that export tax is equivalent to an import tariff in terms of allocations, but not in terms of the exchange rate movement. In fact, the idea here is that you need to achieve trade balance, or intertemporal budget constraint for a country must hold. And so if there is an export tax, on impact, export revenues go down, but that's not an equilibrium. You need imports to adjust as well. And how that happens? Well, you need to reduce imports. That happens by depreciation of the currency. You make imports less affordable, and that will balance out the market. So like export tax requires a depreciation. But then if you can achieve exactly the same allocation with an import tariff, and import sanctions actually do play a role of an import tariff, they reduce imports on impact. That's not an equilibrium because of the intertemporal budget constraints. So you need to reduce exports as well. And how does that happen? Well, that actually requires an appreciation, right? And sort of this is the reverse side of the coin of what is happening in the financial market with supply and demand for currency. But this is now purely real mechanism, and this is what drives the real exchange rate. It's very interesting. I usually start with Lerner symmetry, my master level undergraduate lectures, because, for example, this logic exactly tells you that trying to fight current account deficit with an import tariff is kind of a non-starter, because in the end of the day, you just end up with less trade on both sides, but it doesn't affect the current account deficit or surplus, exactly because of the exchange rate adjustment. And sort of the idea behind Lerner symmetry is all relative prices stay the same. So real wages kind of are affected in the same way by import and an export tariff, but it requires in the background a differential exchange rate adjustment to guarantee the same adjustment of the allocation relevant relative prices. And so kind of like, having said that, then it becomes clear since sanctions were mostly concentrated on the import side and not on the export side, the appreciation is sort of a natural outcome here. What's much more surprising, Lerner symmetry is a celebrated result, but what's much more surprising and kind of comes out of the recent work, in particular this paper with Dima, is that the equivalence is stronger. It's not just in terms of like some allocations, but for example, if you start thinking about fiscal revenues or real cost of living for people, the effects again are the same in the sense that it's kind of very intuitive. If the government draws a lot of revenues from exports of natural resources, an export an export embargo will limit a lot the government's revenues. But it turns out by Lerner symmetry, it turns out even import sanctions, by adjusting the exchange rate, kind of end up having the same effect on fiscal revenues. And that's perhaps surprising, that you can use the import tool to achieve exactly the same fiscal outcomes. And the same is true for real cost of living for people who are more dependent on the import side. But if you do export embargo, you will impose exactly the same cost through Lerner equivalence again. And sort of what's interesting here, the situation is somewhat different. And the way to think about it, if you do export sanctions, you make currency scarce. Yeah, you don't get revenues from the rest of the world, but foreign goods are available. It's just you don't have money to buy them, right? If you do import sanctions, the currency is abundant. You get all those export revenues. You have plenty of euros and dollars in the Russian economy. It's very difficult to buy imports, right? And so sanctions are inherently leaky. And so the question is, which sanctions are easier to go around, right? So obviously, if sanctions were bulletproof, the allocation is equivalent under 10% import sanctions and 10% export sanctions. But here you have plenty of currency, and you need to figure out a way to go around the limit on buying goods, right? If you pay mercenaries a lot of dollars, if they are willing to accept dollars as payment, right, you sort of resolve the issue, right? And here you don't have those dollars to pay, right? But all the inputs are available, right? And so in a way, theoretically, it is the same, but then like which sanctions you need to go around? So in this case, you have to go around the oil export sanctions and try to sell your oil to some countries that are willing to buy it. So you have to sort of go around different sanctions. That's sort of the differences between the two. And the last thing, which in the policy debate, sometimes people said, well, if you did import sanctions, you really don't need to worry about export sanctions. This is wrong because the sanctions are not substitutable. They work cumulatively. And unless you reach full autarky in terms of trade, which clearly has not been reached, right, then the sanctions kind of add up on top of each other. And so the optimal question is, again, very difficult, but you cannot, you might have thought that I'm saying that they're substitutable. Well, they work cumulatively, but they have very, very similar effect in the end, and they will have a cumulative effect. So finally, I want to talk about financial repression, which was an essential part of the policy response, right? And so the point is, again, when currency comes into the country, you can use it to buy imports, or some people want to hold it as a safe asset. And these are competing uses for currency. And if there is big demand for either, it will lead to a depreciation. So you can limit either of the two and curb the depreciation. Basically, if you see what the Bank of Russia did, they did lots of stuff that was financial repression, right? So basically, they forced exporters to sell export revenues in euros and dollars back to the central bank, and they gradually phased it out by now. They imposed limits on what you could transfer abroad in terms of foreign currency. At first, you could not export anything in terms of foreign currency. Then it was increased. Now the limit has been given up. There was a limit on how much you could withdraw from the bank in March and April. There was a tax if you wanted to buy currency in the domestic market. So these are all measures of financial repression that the central bank did in response to reserve sanctions. Sanctions on reserves of the central, and in response to people's wanted to hold dollars as a safe asset. And that essentially allowed to curb the initial phase of the depreciation before the export revenues kicked into the economy. So then there is a question, why do that? Well, the obvious answer is to stabilize the bank run, which the central bank was successful at doing. But then beyond that, once you stabilize the bank run, is there role for financial repression? What's very interesting, it's not the optimal policy, but if this is the only tool that you have left, if you don't have reserves anymore, and if it's the only tool, then this is a very important tool of redistribution between savers who want to use currency to save and consumers who want to use currency to buy the available imports. And if the goal of the government is to kind of like redistribute towards poorer hand-to-mouth consumers, not the savers, right, then financial repression can be an effective tool. And then the question is, once you've done that and stabilized it, can you relax financial repression and create extra revenues for the government? And the answer is actually yes again, that if you relax financial repression, it results in some depreciation of the currency, and it alleviates pressure on the fiscal balance. So in that sense, you know, the question is exchange rate relevant variable or not? The answer is yes, because, you know, by moving exchange rate inside the Russian economy, it's completely irrelevant from the point of view of the foreign market, because foreign investors cannot take advantage of that. But inside the Russian economy, it's a way to redistribute between different users. It's a way to redistribute between savers and buyers, and it's a way to relax the pressure on the fiscal constraint, because the strong ruble is really bad for the Ministry of Finance that needs to pay, you know, the budget expenditures in rubles, so they actually want a weaker ruble. There is a very nice experiment to check that the mechanism actually worked, but I'm going to skip that. And so going back to this picture, this was the phase of depreciation driven by, you know, sanctions on reserves, and being driven by the panic when people really wanted to take dollars and euros as savings vehicle, which was curbed by financial repression. And then exports exceeded imports. And so that led to this force for appreciation. And this is the period when the central bank said, well, this is going way too far. We need to relax financial repression. And they started relaxing financial repression, trying to curb the appreciation, right? And so this is kind of the storyline of what happened in the Russian economy. I'm not going to conclude. One last thing in the end, I want to say this is a sign of sort of Russian resistance to the war. Every Russian knows that it says no to the war. It's a little kind of, it's a tone deaf to kind of talk about the fate of Russians, given that, you know, the destruction in Ukraine and the loss of life and welfare that kind of happens as we speak. But at the same time, for saying that the war is war, you can go for 15 years to jail in Russia. And in fact, it's being implemented also as we speak. So like the few independent politicians who left in Russia kind of are going to jail now for saying that. But like every Russian knows that this says no to war. And so let me stop here.
Fantastic, and fantastic to draw out all the connections between trade and international macro. Our next two speakers are going to join us online.
So thanks a lot. Thanks a lot for inviting me and Ivan to participate to this panel. This was and to this section. It was I learned a lot in the past few days. So. Yeah, in a sense, kind of like the first two papers in the panel were on sanctions that we would have liked to see, but or many of us would have liked to see, and were not actually implemented. So, like severe sanctions on energy exports by Russia. And in a way, the paper that Oleg just presented and the paper I'll be talking about is more instead about the sanctions that did actually take place, and on why the type of sanctions that did take place did some hurt, had some kind of counterintuitive effects on the ruble exchange rate. And that's what I want to talk about. So I want to talk about the sanctions that were actually implemented and whether they reached their goals or not. So kind of the questions I want to talk about are kind of the basic questions. Are sanctions working, at least in the sense of achieving the economic effects that they want to achieve? There's a bigger question, of course, if then they achieve the political effects. That's a much harder question that I don't have much expertise. There is another question that also many are asking these days, especially in the policy sphere, which is how large will be the recession in Russia? Originally, there was a large recession anticipated of the kind of order of 10% of GDP, but now many experts see a smaller recession. And there's a question like, were the sanctions? Is the fact that sanctions were not strong enough? Why we're not going to see a big enough recession in Russia? So that's the kind of questions that are open out there. I'm going to just make 3 points and then raise a question that I find hard, really, and on which I really don't have a strong view. So I'm going to make my 3 points and then I raise my question. So the point number one, which is closely related to stuff that Oleg talked about and is based on the minimalist model in my paper with Ivan, is that you can hurt a country by buying less stuff from the country, and stuff here I include both goods, services, and assets, or you can hurt a country by selling less stuff to it, and that's a general observation, but the interesting fact is that what happens to the exchange rate really depends on which side you hurt more, not on the total pain you're causing. So in a sense, looking at the exchange rate as a measure of success of sanctions is probably not a particularly good idea. And I'm going to make this point using a very simple graph of the currency market. So think of the currency market as the market where we trade foreign currency for rubles, and the exchange rate is on the y-axis, and there is a demand for foreign currency and a supply. So there is a very basic form of sanction, which would be, for example, a tariff on stuff that we buy from Russia. And the effect of that would be to shift the supply here to the left. And so it would actually lead to a depreciation of the exchange rate. The exchange rate would go up. And as usual in international macro, when the exchange rate go up is actually a depreciation, because it means that the foreign currency costs more. On the other hand, our claim in the paper with Ivan is that a lot of the restrictions that were put in place at the beginning after the invasion were restrictions that took more the form of restrictions on stuff that Russia could buy from the rest of the world. Those restrictions mean that now, because Russians can buy less stuff from the West, there's going to be less demand for foreign currency, because there is less that you can buy with foreign currency, and that will shift down the demand for foreign exchange and would actually lead to appreciation of the ruble, which again, because of the convention of how the exchange rate is defined, means actually the exchange rate goes down. So it means that it's cheaper to buy foreign currency. That's the basic point there. And to give you an, I mean, of course, there were many different restrictions that were put in place, but to give you an example, for example, if you think that you're a wealthy Russian and suddenly you cannot really enjoy your house in London, so then the demand for houses in London by Russians will go down. And so there will be fewer Russians that want to convert the ruble's wealth into pounds to buy a house in London. And so the basic observation is that a lot of the restrictions, some legal restrictions and some informal restrictions that have affected Russia because of the war, are restrictions that actually can lower the desire of some Russian nationals to convert their wealth into foreign wealth, and so reduces their demand for foreign currency. That was the basic observation. Of course, not all of them, right? So there is still the demand, for example, if you are a foreign multinational who has a factory in Russia, and then you want to actually get rid of that factory because you realize you're not going to be able to operate there anymore. So then you probably want to convert rubles. You're going to sell it for rubles and then convert it into foreign currency, because you can still use your foreign currency. You're a multinational. You can do what you want with your dollars. So that demand is still there. And potentially the demand by Russians that are afraid of a collapse of the financial system would be also a demand for foreign currency that is there. And that's why Russia imposed very severe capital controls at the beginning, because there were also very strong forces for depreciation. So, but this is the basic observation there, is that there are a number of restrictions that were causing the ruble to appreciate. And that doesn't mean that those restrictions were not painful. The Russian, wealthy Russia was still unhappy that he couldn't enjoy a house in London, but that the effect on the ruble exchange rate of the fact that he couldn't enjoy the house in London was actually to appreciate the ruble. So that's my point number one. Now, my point number two is a more specific point on instead on the more kind of the financial crisis side of the story. So, and here I'm going to make a very simple observation. So one objective of the sanctions for the way they were designed, and in particular the idea of freezing the assets of the Russian central bank, and a number of kind of breaking the Russian banks from the international payment system. My impression is that some of those sanctions were put in place with the hope of delivering a blow to the Russian financial system and pushing Russia into a financial crisis. And so if we take that as the initial objective of the sanctions, we have to be honest and say those sanctions failed. They didn't work. If the objective was to cause a financial crisis, we didn't cause a financial crisis in Russia. Why? Well, for various reasons, but the basic point is that if you ask this question, can you cause a financial crisis in a country that is running a large current account surplus? Sorry, here there is a typo here. This is surplus. With sound public finances and a well-functioning central bank, you cannot really do it. So it was probably misguided, the hope that just by using very strong financial power, you could force a financial crisis in Russia. And this is perfectly consistent with standard theory of financial crisis in emerging economies. I mean, we know how financial crises in emerging economies work. They work when you have a large current account deficits, when the public finances are not very sound and you need to print money, or the central bank makes large mistakes. And none of these conditions were there in Russia. There is this term Fortress Russia, which I think was coined by Elena Rybakova, at least I credit her for that, which is a brilliant representation of the strategy that Russia followed since at least 2014. And it's true that one of the elements of the strategy, which was accumulation of foreign reserves, failed because Russia did not expect the foreign assets of the Central Bank of Russia to be frozen. But still, all the other legs of the policy worked very well. So I think that's one consideration that we must make at this stage in terms of whether sanctions worked or not. Definitely, this approach had limited success. Now, there is a third point I want to make, and this is actually related to also something that a point that Oleg made at some point, and I think it's an important point to remember, which is that, again, there is in the policy debate, there is a lot of discussion of what's going to happen to Russian GDP, and there is a concern, we're not really going to be causing a large recession, because a lot of the large recession was predicated. A lot of the predictions of a large recessions in the early weeks of the invasion were predicated on the fact that there would be a financial crisis in Russia. Now we see that the financial crisis will not happen, probably. It may be that some restrictions on energy imports will take place and will hurt, but probably not enough to cause a major economic crisis in Russia. However, I think a second thing that we have to remember is that what happens to GDP is not necessarily what happens to consumption and welfare, especially in a war economy. I mean, we know in general that's true, and I mean, of course, all the trade models tell us so. But it's particularly true in a war economy. So I think we have to also realize that you can still cause a lot of hurt by imposing certain type of sanctions, like, again, sanctions on stuff that we sell to Russia, at least on the consumption side, even if we're not causing a large recession. So when we're trying to measure the success of sanctions, it's important to keep that in mind. That, I mean, you can still have rationing of some essential goods and of high quality imported goods that can still hurt the population, even if GDP is not collapsing. So these are the 3 points I wanted to make about sanctions. So first point, the ruble is not a good measure of whether sanctions work or not. If sanctions wanted to achieve a financial crisis, well, they failed. On the other hand, the type of sanctions that we are using so far can still cause pain, especially if we focus on consumption. Now, the question that I want to raise, and is a question on which I really scratch my head, is very related to something that was said early on during this panel about how do we deal now with the large energy crisis. So suppose that there is still some room for imposing some tariff on energy imports from Russia. There is still discussion to impose some form of price cap. I know the Draghi government has been very vocal in trying to convince the West to impose some type of price cap. Is that going to work? And how are we going to deal with the scarcity of gas, of natural gas and oil in the West? And here the question that as economists we should know the answer to, but I'm afraid we don't know the answer to, is the following. We are in a high global inflation environment. I mean, inflation is the headline and is the big concern. And especially in the EU, inflation is really driven by energy, like it's pretty much energy. Now, I'm gonna, for example, if we're asking the question, is it better to put a cap on for example, imports of Russian gas, or to put a tariff? And from theory, we know that they're equivalent, because we can put a price cap. It means that we're only going to buy gas from Russia at this price, and then the supply of gas is here, so we're going to get less. The difference is that with a tariff, we have a very efficient way of allocating this scarcer resource, right? Because we're going to have the price mechanism doing its work. And as Rudy was saying, Rudy was saying the price mechanism is always the best. And that's our kind of instinctive reaction as economists, is to say that the price mechanism is the best. The concern, and I think a big reason why Mr. Draghi loves a cap, is that means obviously very high energy prices. And I'm not sure that actually politicians in Europe today prefer to tell people, turn down your thermostat. You cannot shower on Tuesday, but the price of energy is still low. And so my impression is that they prefer rationing, because in a high inflation environment, high prices are just psychologically bad. Even though we know that the price mechanism is usually the best. So this to me is an open question, whether we're gonna have to deal with scarce energy, whether because we do it or because Mr. Putin decides to do it. The question is, the natural response as economists would be, let the prices do the job. In a high inflation environment, I honestly actually don't know the answer.